Hey everyone, and welcome. Ever stop and think about the invisible forces that decide the price of, well, everything, from your morning coffee to your phone? Today, we're going to pull back the curtain and see how markets really work.
So let's just start with something super simple that gets right to the point. Why does a can of soda cost what it does? Not a penny more, not a penny less. The answer isn't just pulled out of thin air. It's the result of this powerful economic dance.
To answer that question about our soda can, we first need to understand the arena where this all goes down. So welcome to the market. It's basically the meeting point for everyone who wants to buy something and everyone who wants to sell it.
Okay, so what is a market, really? It's not always, a physical storefront or a trading floor. It's any situation where producers, the people willing and able to supply something, connect with consumers, the people willing and able to demand that same thing. It's all about that interaction.
Let's bring this back to our soda example. Just imagine if cans were $5 a pop. Producers would be loving life, right? Huge profits. But how many of us would actually buy one? Probably not many. Now flip that. What if they were, say, 10 cents? We'd all be lining up, but pretty much no company could afford to stay in business. And that tension, right there, that is the engine of the market.
All right, let's unpack that tension a little bit. We'll start with one side of the coin, the power of demand. What is it that drives us, the consumers? In economics, demand is a bit more specific than just wanting something. I want a private jet, but unless I've got the cash to back that up, it's not what we call effective demand. For it to count, your willingness to buy something has to be matched by your ability to actually pay for it.
And this brings us to a really fundamental idea, the law of demand. And honestly, it's incredibly intuitive. When the price of something goes up, people tend to buy less of it. And when the price falls, boom, there's a sale, people tend to buy more. That simple inverse relationship is exactly why the demand curve always slopes downwards.
But it's not just about the price tag. All sorts of other things can shift demand completely. For instance, if you get a raise, you've got more disposable income. Or maybe the price of a substitute product, like a competing brand, goes up, so you switch. Even things like a really great advertising campaign or just more people moving into an area can boost demand for a product across the board. Okay, so we've got the buyer's mindset down. Now let's flip the coin and look at the logic of supply. What's motivating the companies that are actually making and selling all this stuff?
And just like with demand, supply is about two key things: a company's willingness to sell a product and their actual ability to produce it and get it to the market. A car company might want to sell 1 million cars, sure, but if their factory can only crank out 500,000, well, that's their real effective supply. So here's the other side of the coin to the law of demand, the law of supply. And this one works in the exact opposite direction. As the market price for a product goes up, it becomes more profitable to make it, so firms are motivated to supply more. But if the price drops, profits shrink, and so does the motivation to produce. Simple as that.
And again, price isn't the whole story here either. If production costs go down, say the aluminum for our soda cans gets cheaper, it's easier for companies to supply more. New tech can make factories way more efficient. Even just a feeling of optimism about the economy can make a business decide to ramp up supply, hoping for future profits.
Okay, so you've got consumers who want low prices and producers who want high prices. Two powerful forces pulling in opposite directions. So what happens when they actually meet in the market? Well, this is where the real magic happens.
They meet at a point called market equilibrium. And it's exactly what it sounds like. It's the sweet spot. It's that one perfect price where the amount of stuff consumers want to buy is exactly the same as the amount of stuff producers want to sell. No shortages, no leftovers. The market is perfectly balanced.
But what happens if the price isn't quite right? Well, the market has this amazing way of correcting itself. If the price is too high, you get a surplus. Soda cans just sit on the shelves unsold. So what do stores do? They drop the price. And if the price is too low, you get a shortage. The soda flies off the shelves instantly. That's a signal to sellers that, hey, they can probably raise the price a bit.
So this whole dance of supply and demand is incredibly powerful at finding the right price. But the real world, as you know, is a bit more complicated. So let's look at a couple of things that can really shape the market's final outcome. Here's a really interesting question. When the price of something changes, how much do we really change our buying habits? The answer is, it depends. And this whole idea is called elasticity.
So you've got two basic flavors here. Demand is elastic when a little price change makes us change our behavior a lot.
Think about laundry detergent. If one brand raises its price, you'll just grab the one next to it. No big deal. But on the flip side, demand is inelastic when price changes don't really move the needle for us. Take electricity. I mean, even if your bill goes up, you're still going to keep the lights on, right? Now, everything we've talked about so far describes a market pretty much left to its own devices. Adam Smith's famous invisible hand guiding everything. But is that how it always works in the real world? The answer is, for the most part, no.
Governments often step in to, nudge the market one way or another. And they basically have two main tools in their toolbox. They can use indirect taxes to make things like cigarettes or gasoline more expensive, hoping people will use them less. Or they can do the opposite and offer subsidies to make things like medicines or clean energy cheaper, to encourage us to use them more.
This petrol tax example is perfect for seeing how this plays out. Okay, so let's say gas starts at 80 cents a liter. Then the government slaps on a 40-cent tax. Now, you'd think the new price would be $1.20, right? 80 plus 40. But look, the price only goes up to $1. So what happened to the other 20 cents? Well, because the price went up, people started buying less gas. So to keep their customers, the producers had to eat that 20 cents of the tax themselves. The burden gets shared.
And that really brings us to the big final question here. The market is, without a doubt, a powerful and pretty efficient machine for figuring out who gets what. But it doesn't always lead to the outcomes we as a society might want. So when is it right to just let it do its thing? And when is it right to step in and try to guide it? That is one of these central debates in all of economics. And it's definitely something to chew on the next time you go to buy a simple can of soda.